Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It will help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content and programming at Deal Catalyst. Before I get into some of the interesting things we're going to cover, as well as the launch of our new feature here, I wanted to mention that our direct lending conference in Nashville, prices are going up at the end of next week. So if you haven't yet gotten your ticket, this is the best price you're going to get. So please, before you register, you can use a code. You could hear it in the open here. Just use the code CREDIT. But I wanted to kind of give a special highlight to that, given I know a lot of you are probably thinking about going to that conference. So please do make sure you use the code CREDIT, as well as take advantage of the cheapest price, because by the end of next week, ticket prices will go up, and there'll be some other price breaks along the way. But right now is your best chance to get the cheapest ticket available. I wanted to launch a new feature. I read the news, listen to pods, read white papers, try to stay, really, in tune with what's going on in the credit markets, private credit, and obviously the areas that we cover on. So with that, I wanted to launch Inside the Spread. And so Inside the Spread is going to be covering the latest news and intelligence from credit markets, with an obvious special focus and attention on direct lending, asset-based finance, fund finance, and structured credit. And so how often we do this, I'm still trying to figure that out. If it's a less of a news week, I don't want to force something on there. So I'm going to call this Volume 1. And so, keep an eye out for it. We also have some really, really exceptional and fun guests in the pipeline. Some of that's taking a little bit longer with some approvals and whatnot, but I think you'll be excited. Some managing partners and some really big names. And so, I think you'll all find that, I think the podcast is continuing to mature, and for me, it's a passion and a really fun part of my job. And so hopefully you find this new feature interesting and fun. And I do encourage you guys to reach out if you ever wanted to, send questions, or maybe I'll do eventually, if we get to the point of having so many viewers and listeners, maybe I'll do a mailbag and you could send me questions via email and I'll answer them. But for now, until we, I guess, grow a little bit bigger, we'll do Inside the Spread. So, just before we get into obviously the bunch of news and items I thought were interesting this week, you can obviously see I'm sporting my Bill sweatshirt again. And, this is the time of year, especially the last 5 years, that the Bills are in the playoffs. And anybody but who knows the history of the Bills, it's been a fun, troubled, excruciating history. The only team ever to make 4 Super Bowls, but yet the only team ever to lose all 4 of those Super Bowls. And then in recent times, we haven't been able to get past Patrick Mahomes and the Kansas City Chiefs. So we don't have the barrier of Mahomes this year. Also, Lamar Jackson, Joe Burrow are not in the playoffs. Allen and the Bills have not lost to the Ravens, but they have lost to both the Chiefs and the Bengals. So that hurdle is gone. But there's another hurdle, which is playing on the road, which is something they haven't had a ton of success on. It's been a long time since the franchise itself has won a playoff game on the road. Now, some of that is a bit misleading given that most of their playoff games the last few years were at home, and pretty much the only game on the road was at the Chiefs. But be that as it may, their road playoff, losing streak goes a long time. I think it's about 30 years, 0-9, I think, somewhere in there. But without getting into details of all that, they play the Jags Sunday at 1, and so hopefully I'll be a happy camper when it comes to next week's episode. It is not a fun experience watching a game, at least with me. There's a lot of pacing. There's a lot of sitting up, sitting down, walking around the house to calm myself down. It's it's not a fun experience. It's pretty excruciating, especially probably for my wife and kids. But it is that time of year. Bills have a chance to maybe make a run here, but it won't happen unless they obviously win that first game against the Jaguars. So let's hope. I'm not going to make any predictions. I'm a little superstitious when it comes to predicting my team's doing anything, so I'll stay away from that and just say "Go Bills." And as the famous, Bills saying goes, "Where else would you rather be than right here, right now?" And that's something that old Coach Marv Levy used to say before every game. So now let's move on to our first volume of Inside the Spread, and I think you can't really start a feature like this when it comes to talking about news and intelligence and whatnot in the credit markets without the couple of announcements that I think came as somewhat of a surprise to the markets from the president and the administration. And so the more recent one of the two is obviously the credit cards at 10%. Now, this isn't the first time we've heard of, I'd say there's two pieces to it. One, that Trump has mentioned this. I think it was on the campaign trail in the last presidential election. He had mentioned it related to the affordability question because obviously inflation was quite high during the election and for the previous administration. But it certainly came out of nowhere from the announcement. There is a bill, I believe, in the Senate with Senators Bernie Sanders and Josh Hawley that calls for a similar 10% cap on interest rates. Now, there's been just a real swift pushback from both the banking and other lobbies that if you were to institute this, that would cascade down to credit being cut off for those with, I guess you could say near prime, subprime credit scores, in that, the cap will force banks and other providers of credit to say, we can't underwrite someone if our return or if the interest on a product is only 10%, then it needs to fall into the prime or super prime category, and therefore people will be cut off from credit. And then that forces them to options that are less regulated and where interest rates could be 200, 300, 400%, or loan sharks or things like that. And so at the very least, your typical credit card or other product can at least keep the credit flowing for people that need it. But given that there was very little detail around it, I think a lot still needs to be sorted, for the credit card interest rate caps of 10%. The other announcement, which was equally, I think, surprising, related to single family homes and who can own them, given that it's become a pretty hot investment opportunity for private credit funds. Now, it does give the caveat of not existing portfolios, but I think future purchases of portfolios or homes. And so what that means for large private credit funds that have dedicated a strategy and raised a lot of money for this, I don't know. I think there's still a fair amount to be figured out there, but clearly something that the administration is at least keen to at least explore with that announcement. I believe more needs to be done to actually enact such announcement, but I think the conversation has now started, and I think that does put some large private credit funds who've dedicated a lot of time and energy and capital to the space in a bit of a precarious position. So I think a little bit more to come on both those items. I think related to those, though, I think coming into the new year, I would have to say regulation clearly is a big focus in 2026, especially as it relates to private credit. You know, the banking regulation has, since the new administration took office, has been eased a bit. And there's still some that think banks will kind of change their behavior and become more forward facing. I don't. I think they've gotten into a pretty comfortable position where they are underwriting funds or platforms. And so I think they'll stay there. But I think scrutiny on private credit will definitely rise. I think there's been some regulation murmurs and rumors, as well as some lawmakers starting to push. Should we be examining this space a lot closer? And in some ways, I think that's good. Markets very rarely will supervise or regulate themselves, at least in a way that is adequate. And so, I think it's a natural evolution of a market that's growing. Some people, I think Apollo, have put the size of the market potentially at 40 trillion. Direct lending is somewhere in the 2-ish trillion range. ABF is probably 2-3 times that today. But if you're talking about the total addressable market, I'd say between somewhere, I guess, between 20 and 40 trillion, which is, enormous. And if you get to those sizes, it clearly then becomes a systemic risk, and is certainly in need of more eyeballs and scrutiny. And so I think you'll find that this year and probably rolling into the next 2 or 3 years, the regulatory eyeballs will become a bit more focused on the private credit market, at least here in the U.S. Where that lands, it really kind of depends on who's in power. And we have midterms this year, so I don't think anything meaningful will happen given the election cycle that we're running into this year. But I'd say keep an eye on the U.S. for the next 2 or 3 years. At least some, a little bit of increased regulation, or at least guardrails beginning to be put around the private credit markets. In the Europe and the UK, I think you're going to get probably a more stringent reaction. You even had this week, I think there's a group in the UK's House of Lords that criticized the Treasury for its limited grasp of risks related to private credit markets, and says that the Bank of England needs to move faster. I think the BOE has set a stress test for results to come out, I believe, end of 2027. So it's about a little under 2 years now. And clearly, this group of lawmakers is pushing for some of that to happen sooner. I think the fear is that some of the negative things of where private credit happened here in the U.S. with some of the fraud related issues, and not all of that, by the way, was private credit related. Some related, some more tangential, might make its way across the pond, and they want to maybe try to get ahead of that. So I think regulation is clearly one of the things that credit markets need to keep a close eye on. But on the flip side, fundraising, I'd say, is still quite strong. Just this week, I saw Benefit Street, Guggenheim, Davidson Kempner, KKR all raise capital for private credit strategies and private credit funds. Some of that in real estate, some in Asia, and we'll touch a little bit more on the Asia piece in a few minutes. But clearly, the appetite is continues to be strong in private credit, and that's for many different flavors of private credit, which clearly has moved beyond the core definition, which used to mean direct lending when it kind of burst on the scene a few years ago. With Intelligence just put out a report that really, I think, showed, and something that we touched on the pod a few times since we've launched, is the appetite for Europe. Because I remember talking to, it was Takao Capital in particular, a European private credit fund manager, I think a French-based one, that had talked about kind of this push into Europe. And the data from the report, certainly hint at that. With fundraising hit a record 66 billion through 9 months of 2025. That's up 17% from 2024. European funds accounted for 35% of all private debt fundraising in the first 9 months of 2025, excuse me, which was up 25% from 23 and 2024. And then North America funds raised 52 billion, which is about 24% of the overall, a sharp fall, the report says, when it accounted for about half. So, I mean, we went from 50% of the total funds raised for private debt down to 24%, which is a pretty precipitous fall in the last couple of years. I mean, we talked about it on the pod. Some of that is probably due to the uncertainty of the current administration here and announcements just like this week out of the blue. And I think that Europe, while less appealing, broadly speaking, when it comes to, real return, so to speak, I do think the consistency it has showed the last couple of years has probably put more people at ease a little bit. And as some have become more selective in their choices in private credit, given some of the fraud and other related issues here, I think Europe has become a bit of a safer, steadier bet. And I think this report kind of bears some of that out, given the numbers. And from everything I've read the last 10, 12 days or so, I mean, the signals are showing Europe is set for yet another banner year in 2026. Now, will the U.S. rebound a bit? I would probably think so. And some of the indications of that group of firms I mentioned show that appetite in the U.S. is not necessarily waning overall. I think it's just spreading to different markets more equally today than, say, 2 or 3 years ago. And obviously, that report certainly bears that out. The other thing that we've heard, and have certainly started to cover more at our conferences, and the report also touched upon, is that the proliferation, excuse me, of evergreen structures. And so, assets held in evergreen private credit funds have now surpassed 640 billion. That's up 28% from end of 2024, and 45% year over year. So that is a significant jump. And I'd say, if looking at the topics that I've heard most in the past year, Evergreen is certainly near the top of the list. Maybe it's not at the very top, but certainly close. And so I think, the continued proliferation of different structures within private credit continues to make private credit that much more appealing, as spreads and real return have maybe dipped, comparatively speaking, to private and other investment strategies. I do think private credit, which arguably its biggest benefit is flexibility, and I think the flexibility of structures lends itself to the market still having a strong appetite when it comes to fundraising, and that's evident, by some of the things I was just mentioning, the report, as well as some of the news items I've been reading the past couple of weeks. I did want to touch on Asia and the Middle East, because we've certainly, it's been dominated, the private credit market that has been dominated clearly by the US and UK/Europe. But KKR, part of the reason I wanted to highlight it was, they raised 2.5 billion to scale in Asia, and Asia more so than probably the US, clearly. And Europe is a very, very bank concentrated market. I think Latin America is probably the best comparable there. And so seeing that KKR raising that much capital to scale their private credit operations in Asia, I think is an interesting thing to keep an eye on. We host 2 events in the Middle East that touch on private credit, and the appetite there is clearly increasing, without a doubt. You have more funds that want to go there. and talk to local investors, both sovereign and other. And so I think seeing where some of the private credit markets begin maturing, or at least diversifying away from what traditionally was a bank, like 95 to 98% bank dominated market, I think is interesting because there's so much capacity to lend in some of these markets. I mean, as someone who used to run events in China, just the sheer volume of some of what was being done in 2016, 2017, 2018 from a lending standpoint, especially a fintech lending standpoint at that time, was just extraordinary. The volumes are just so big, and I think if there is an opening up of whether it be China or some of these other markets to private credit, I think that's an interesting thing to keep an eye on, and one worth watching. Who else might also raise significant capital to go there? Before we wrap up with this new feature inside the spread, as we mentioned at the top, the other thing I wanted to mention that was certainly, I'd probably say, up there with Evergreen structures was secondaries. Especially with a lot of the uncertainty in the U.S. Secondaries appeal continues to grow, and while many have said 2025 is kind of a uneven year, it looks like 26 is setting up to be a lot bigger. Though some of that depends on who you talk to, and there was a piece I read, with some of the bigger names, Apollo, Collar Capital, and others, who basically had differentiating views on kind of what the deal making environment might look like in 2026. But clearly, the appetite for secondaries continues to grow. If you look at it just as a volume game year on year, and I think it's setting itself up for a pretty big year in 26 / into 27. And so that's another term I'd keep a close eye on, in the next couple of years. Private credit, and then obviously evergreen structures, evergreen funds, as well as secondaries. A lot of things are kind of beginning to splinter off in bigger ways in these markets. And I think it's a real, fascinating thing to keep an eye on. As I mentioned at the top, our early bird rate for our direct lending conference in Nashville is expiring the end of next week. So if you haven't yet gotten your ticket, please do so. It's the best price you're going to get on it, and you can use the code CREDIT to get a little bit bigger of a discount. So don't forget to do that. And as I mentioned quickly at the top about my Bills, Godspeed with them. So go Bills, and until next time. Thanks. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.